Now let us recall the importance of cash to a business and pursue our thinking along these lines a bit further, in particular with regard to cash balances. Now, the cash budgeting should seek to determine whether or not cash surpluses or deficits are anticipated. In the event of either, management has to have a clear strategy as to what it's going to do to either invest surpluses or to borrow to cover deficits. If a deficit is short-term in nature, then of course overdraft facilities should be negotiated with the bank. If the deficit is actually going to be a more protracted one, then the company should think about borrowing longer in the form of longer-term finance in order to properly meet its cash needs. On the other side, if one is an insurance company, for example, or any company that's selling on like fast food business, which is selling for immediate cash and pays its suppliers later, then of course it's in the happy position of having to invest these balances. Now, if a surplus is going to be temporary, it makes sense to put the cash in deposits or into some sort of money market or treasury bills that will earn a safe return and is also immediately realizable. That is, can be transformed back into cash when needed. If the cash surpluses are permanent in nature, then of course the company can consider using that cash to make capital expenditures, to invest in the long term of the business, or if it has more cash than it actually needs for operating purposes, it can also either pay down debt, which means to repay loans, or to even pay special dividends to the shareholders. So cash and finding the optimum level of cash has been a concern for a number of researchers, and we have a couple of models that are mentioned in the syllabus with regard to managing cash. One is called the Baumol model, and the Baumol model is best understood as as an analogy, say, to the economic order quantity model. If the candidate can remind himself or herself of the formula that was used in connection with determining the optimal quantity of materials to be ordered, the economic order quantity. The Baumol model follows that kind of thinking and looks at cash as sort of like inventory, and therefore excess cash is invested in marketable securities, and a certain amount of it has to be liquidated on a periodic basis in order to transform or to liquidate the securities and bring them back into cash, which is considered to be analogous to the ordering costs that we're familiar with in the economic order quantity theory. Also, the interest rate, of course, with holding cash represents an opportunity cost because we could be earning interest by investing the cash. So we might look at this holding cash as being kind of a holding cost, analogous also to the economic order quantity. Therefore, the variables in the Baumol model are N denotes the total amount of cash required. F is the transaction cost each time we need to sell securities and pay the brokerage fees in order to get cash back into the business and immediately available. And I is the annual interest rate that's obtained on investments in securities. Therefore, Z becomes the amount of cash that needs to be raised, or we could say ordered per transaction. It's very similar to the Q in the EOQ formula. And the formula for the optimal level of Z is in fact the square root of 2n times F divided by I, the interest rate. Now, I'm running over this formula in rather a summarized fashion because it is considered to be rather simplified and perhaps not so realistic, because it assumes that cash disbursements are constant and predictable, which is often the case, not the case with regard to the to cash management issues in the company, which is why another model has been developed which tends to be a little bit more reality driven. It's called the Miller-Orr model. Now, what Miller-Orr seeks to do is to map out, based on the variability of net daily cash flows. So this is something which has to be statistically based and measured. What Miller-Orr is seeking to do is to define maximum and minimum points beyond which the cash cannot rise or return to. In fact, the minimum level is set by policy. But depending on how volatile cash flows are, the Miller-Orr uses the formula which is shown here to define a level of cash R, which is considered to be the point to which cash balances have to be adjusted if they have touched the maximum level, called the upper limit, or the minimum level, the lower limit. In other words, R would be the return point, which would be situated right about here. So let's just look at this in a dynamic way. If our cash position starts here and starts to fluctuate up and down, if it reaches the upper limit, then it has to be adjusted down to the R level. And if at that point, that means that if we have too much cash, we've reached the upper limit, we have to remove this amount of cash and invest it in securities so as to return to the R limit, the point of return. If the cash proceeds to move from that point and goes down and touches the lower limit, then we also have to adjust the cash back up to the point, to the level of return, by liquidating securities transactions to create cash and bring the balance back up. That is the idea behind the Miller-Orr. It's much more statistically based and dynamic kind of cash management model, which is recognizing the fact that our cash is going to move rather erratically between upper and lower limits, and it's seeking to define an optimal level of point or of return to which the cash balances have to be adjusted. Okay, let's move on to working capital needs now and funding strategies, because again, decisions have to be made. This is more or less a summarization of what the company financial director has to, or CFO has to think about in terms of handling, well, this is actually the cash manager's role, because it's got short-term implications here. Funding strategies will depend on whether the shortages and surpluses are permanent or temporary, and there's the matching principle applied here. Fixed assets usually should be funded long-term, because the repayment schedule for a long-term loan would be more appropriate for a fixed asset, which is only going to pay its way or generate a return over the longer term. Whereas current assets, they can be quite volatile in their nature, and therefore when you have seasonal swings in inventories and so on, it's normal to borrow short-term against that, because the short-term borrowings can be liquidated as sales are made. We've also talked about cash surpluses and the things that the company can do with those. Liquidity ratios, basic knowledge, and this is very, very basic stuff that the candidate should really know in his or her sleep. That is the current ratio, very, very basic. The quick ratio, as being basic measures of liquidity. And finally, the importance of appreciating the relationship between a bank and a customer, which is set in contractual terms, but there are also, of course, professional norms which apply, and a bank has a professional duty of care towards the client, not only in terms of confidentiality, but also in acting and proposing solutions which are appropriate to the client's situation, and certainly not to take advantage of the client. Of course, the relationship between bank and customer has been put to some, quite a severe test during the financial crisis, depending on what the situation of the bank has in question has been. Clearly, as long as customers weren't too concerned about the financial health of their banks, a customer was happy to borrow from any bank that was giving them the cheapest rates. However, the financial crisis has shown that it's also important for a customer to choose the bank carefully. This is especially true for individual customers who take mortgages from banks and don't want to find themselves suddenly being foreclosed by the bank in some sort of aggressive way. But even for companies as well, if companies enter into short-term liquidity problems, they want to have the assurance that they're working with a bank that is taking a relationship view towards the customer and able to stand by a customer through thick and thin, rather than to immediately ask for its money back. And then the final angle to keep in mind here is the position of the legal authorities, justice and tax authorities, which really constitutes a third party entering in or affecting the relationship between bank and customer in terms of launching investigations, wanting to ensure that money laundering is not being practiced, and of course to make sure that companies are paying their fair share of taxes. So the relationship has become complicated by what almost amounts to a triangular relationship with the third party, i.e. the authorities playing a role in, one might say, possibly interfering or intruding on the relationship between bank and customer.